Hello, friends. Most widows believe the SSA automatically gives you the best possible survivor benefit when you apply. That is not true. The SSA gives you the benefit you asked for, on the date you asked for it, at whatever reduction applies to that date. The automatic part is the reduction. The part that requires action is getting the full amount. And the difference? Right now, in 2026, for a widow who claims at the wrong age versus the right age, is $516 a month, permanently. That number, $516, is not hypothetical. It is not a worst-case scenario. It is the gap between what the SSA will offer and what the SSA owes. And most widows never know the gap exists. If you are new here, subscribe and turn on notifications. The next video in this series covers 3 more SSA rules that cost retirees thousands every year. You need to see that one now. The widow's already inside this trap. The SSA's own actuarial data tells a brutal story. Right now, in 2026, an estimated 1.8 million widows between the ages of 60 and 66 collect survivor benefits they claimed before full retirement age. Every one of them locked in a reduction the day they signed, not a temporary cut, for life. These women made the decision during the worst months of their lives, some within weeks of a husband's death, sitting in an SSA office or on a phone call, the low hum of a government building in the background, a voice reading them a number. They said yes. They did not know there was a better number. The SSA did not tell them. That is the thing about the automatic benefit myth. The system does not lie to you. It just does not volunteer the truth. Mistake number 1. The most expensive mistake on this list. When a widow claims survivor benefits at age 60, the earliest eligible age, the SSA locks that benefit at 71.5% of the deceased spouse's primary insurance amount. The PIA is the base calculation of what your spouse earned over a lifetime of Social Security contributions. At 60, you receive 71.5% of that number. Not for a few years, not until 67. For life. Until the last check. Full retirement age for anyone born in 1960 or later is 67. At 67, the same widow receives 100% of that PIA. No reduction, the full amount. The distance between those two ages, 7 years, costs $516 every single month. Honestly, think about what that number means over time. $516 a month is $6,192 a year. Over 20 years, the average remaining life expectancy for a woman who survives her husband at 65, that is $123,840. Gone. Not taken. Never received. Because nobody explained that the first number offered is not the best number available. The automatic benefit myth tells you the system handles this for you. It does not. Before mistake number 2, which involves a form almost no one files and a 2-year clock already running, understand what drives widows to claim at 60 in the first place. Income stops. Grief is not a planning environment. The SSA processes the death, confirms survivor eligibility, and presents a benefit amount. The widow says yes. The call ends. The reduction locks in. For life. No second call. No letters saying the number could have been higher. No follow-up from the SSA explaining that waiting 7 years rewrites the math. Mistake number 2 is smaller in dollar terms, but it reveals the pattern that runs through every mistake on this list, and it sets up what you need to understand before we reach mistake 7. The one that costs the most. Form SSA 8 is the application for the lump sum death benefit. The amount? $255. That number has not changed since 1954. 72 years. Not adjusted for inflation, not reviewed, not discussed. $255, paid once, to the surviving spouse or a qualified child. To receive it, you must file Form SSA 8 within 2 years of the date of death. The SSA does not send you this form. No call, no letter in the weeks after a spouse's death explaining that a filing deadline is now running. The widow must know to ask. The widow must know the form exists. An unknown but significant share of eligible surviving spouses never file, not because they chose to leave the money behind, because the clock started without anyone telling them. $255 does not change a life, but the pattern does. The SSA processes what you ask for and does not volunteer what you are owed. That pattern has 5 more mistakes still to come, and one of them involves a Medicare trap that lands in January on a statement with no warning and no phone call. So here is what we know. The SSA locks survivor benefits at 71.5% the moment a widow claims before full retirement age. $516 a month for life, with no disclosure from the agency that set the reduction. And a form called SSA 8 has a 2-year deadline the SSA does not mention, does not mail, and does not explain. 2 mistakes, both invisible, both structural. But nobody in this system can explain the deeper question: why a federal agency responsible for the financial security of 2.9 million surviving spouses does not disclose, at the moment of application, what the claimant is about to give up. That question has no published answer, and it points to a second track where the same silence compounds into a medical penalty that never goes away. This second track involves Medicare. It starts the day a spouse dies. But before we get there, something happened with Form SSA 8 that you need to hear. A woman in Dayton, Ohio. Her husband died in March 2021. She handled the funeral, the estate, the accounts, the calls. The SSA processed the death, confirmed her survivor benefit, and sent her a letter with a dollar amount. She filed nothing else. 3 years later, in 2024, she read something online, not from the SSA, not from any government source, that mentioned a 2-year deadline for a lump sum death payment. She checked. The deadline had passed 14 months earlier. $255. Not enough to change her life. More than enough to change how she understood the system that was supposed to protect her. That is what the pattern does. It is not one mistake. It is the discovery that the mistakes were always waiting. Mistake number 3, and this one has a clock. When a spouse dies and carried employer-sponsored health insurance that covered the widow, through his job, his retirement plan, his union, that coverage does not transfer. It stops. In that gap, Medicare opens a window. 8 months. The Medicare Special Enrollment Period. 8 months from the date the employer coverage ends to enroll in Part B without penalty. Miss that window and the cost follows the widow for the rest of her life. A widow who misses the 8-month window must wait for the January General Enrollment Period, which runs only January through March, and Part B coverage does not begin until July 1st. That is a gap of months with no coverage at all. Then, when the coverage starts, the SSA adds a 10% permanent penalty to the Part B premium for every 12-month period the widow went without coverage. The 2026 Part B premium is $185 a month. A 1-year gap adds $18.50 every month for life. A 2-year gap adds $37 for life. No letter arrives after the death certificate is processed to explain that the 8-month clock has started. No call from Medicare. No notification from the SSA. The widow must know the window exists. The widow must know to move. Same silence, same pattern, a different kind of bill. Mistake number 4 is where the pattern stops being an inconvenience and starts being something close to negligence. Right now, in 2026, a single widow with a monthly income at or below $1,275 qualifies for the Qualified Medicare Beneficiary Program, QMB. That program eliminates the $185 Part B premium. Gone. It eliminates the Part A deductible, $1,676 per benefit period. Gone. It eliminates all Medicare cost sharing, deductibles, copays, coinsurance. Gone. $1,275 a month. For a widow drawing a reduced survivor benefit locked in at 60, that threshold is not distant. It is close. It is reachable. A significant share of women watching this video right now may qualify and not know it. Above that ceiling, a second program, SLMB, the Specified Low-Income Medicare Beneficiary, has a higher income limit and covers the Part B premium alone. $185 a month, $2,220 a year. Returned. Neither program is mentioned at Medicare enrollment, not by the SSA, not by CMS, the Centers for Medicare and Medicaid Services. No checkbox on the enrollment form, no line in the welcome packet, no caseworker call. To access either program, the widow must apply through her state Medicaid office, a separate agency, a separate process, a separate form. Most do not know it exists. Most never ask. QMB enrollment among eligible beneficiaries runs at roughly 40%. 60% of the people who qualify never receive the benefit they are owed. That is not a data anomaly. That is the system producing the outcome it was built to produce. But here is where it gets strange. Because mistakes 5 and 6 are not about what the SSA fails to mention. They are about a calculation the SSA runs every January, one that can erase an entire cost of living raise before the widow ever sees it in her account. And the number it uses to do that has not been public knowledge for very long. The calculation runs every January. The SSA does not write to warn you it is coming. It pulls a number from a federal tax database, your income from 2 years prior, and uses that number to determine what you owe on Medicare for the current year. If that prior year income crosses a threshold, the SSA adds a surcharge to your Part B premium. No phone call, no letter of warning, a new deduction in January. This is mistake number 5. And for widows, the math is built to ambush. When a couple files taxes jointly, the 2026 IRMAA threshold, the income-related monthly adjustment amount, the Medicare surcharge trigger, is $206,000. Safe under that number, no surcharge. Many two-income households live comfortably below that line. Then, the spouse dies. The widow files as a single person. The IRMAA single filer threshold for 2026 is $103,000. Half. The same household income that was below the married threshold is now above the single threshold by a wide margin. The SSA looks back at the joint tax return from 2 years prior, the year the couple was still filing together, and calculates a surcharge based on that income, applied now to a single widow living on a fraction of what that household once earned. A household that earned $180,000 as a couple sat safely below the married threshold. That same $180,000 pulled from the prior tax year and applied to a single filer in 2026 sits $77,000 over the line. The surcharge does not arrive as a warning. It arrives as a deduction in January. Calculated on an income the widow no longer has. The number is not hypothetical, neither is the woman it landed on. a retired teacher in Columbus, Ohio. Her husband died in March 2023. They had filed jointly that year on a combined income of $174,000. His pension, her part-time consulting, his Social Security. The following January 2025, her Medicare Part B deduction changed. She noticed it in the bank statement, that quiet, wrong number in a routine line. No letter had arrived explaining the change. She called Medicare. They confirmed. Her 2023 joint return had triggered the IRMAA surcharge for the current year. Her income in 2025 was $61,000. Her Medicare bill was calculated on 174. She had paid into this system for 31 years as a public school teacher. She did not know a Medicare appeal form existed. That is the machine working as designed, not as described, as designed. The form is called SSA 44, Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. It allows a widow to appeal the IRMAA surcharge using her current year income when prior year income included a non-recurring event, a spouse's salary, a joint investment, and inheritance. The SSA accepts this appeal. It reduces or eliminates the surcharge. The SSA does not include Form SSA 44 in the standard IRMAA notice. The notice states the surcharge amount and the appeal's deadline. It does not explain that an appeal on life-changing event grounds is available. The widow must know to ask for a form that the letter never named. The Columbus teacher found SSA 44 through a Medicare advocacy nonprofit. She filed. The surcharge was reversed. She received a refund for the months she had overpaid. Most widows do not find the nonprofit. Most do not find the form. Mistake number 6 is different in character. This one the SSA discloses, in writing. The problem is when. The Government Pension Offset, GPO, reduces a widow's survivor benefit by 2/3 of any government pension she receives. A widow collecting a state teacher's pension, a federal employee pension, a county worker's pension, the SSA reduces her survivor benefit by 67 cents for every dollar of that pension. If the pension is large enough, the survivor benefit disappears, not reduced, gone, to zero. The Windfall Elimination Provision, WEP, operates on a different calculation. It reduces the widow's own Social Security retirement benefit based on years she spent in employment that did not pay into Social Security. Public school teachers in 15 states, federal employees hired before 1984, police officers, firefighters. The reduction formula is technical. The dollar impact is not. Combined, GPO and WEP can eliminate the survivor benefit and reduce the widow's own retirement benefit at the same time. For a public sector widow, a retired teacher, a retired state employee, a retired county nurse, the total reduction can be total. She receives nothing from the survivor benefit she expected, and less from her own benefit than every SSA statement she received over 20 years had projected. The SSA sends a disclosure. It arrives inside the enrollment packet. In enrollment language, dense, administrative, cross-referenced, GPO and WEP are described. The widow signs. Coverage begins. The first check arrives smaller than she expected, and she has already enrolled. The disclosure is not a warning. It is a record that she was informed. But mistake 7 is where this entire series of failures converges into something that makes no sense on paper. Because mistake 7 is not about what the SSA withholds. It is about a provision written into the SSA's own rulebook that can add more than $1,000 a month to a survivor benefit. A provision the SSA will never raise unless the widow uses its exact legal name. And most widows go to their graves without knowing that name exists. Mistake number 7 is the only one on this list that goes in the other direction. Every mistake so far has been a subtraction, a reduction locked in, a deadline missed, a surcharge applied, a benefit offset. This one is an addition, a legal optimization written into SSA policy under Title II and POMS RS 00615.090, the Program Operations Manual System, the SSA's internal rulebook, that can deliver more than $50,000 in additional cumulative benefits over a widow's lifetime. And the SSA is not required to tell you it exists. The strategy is called file and switch. Here is the structure. A widow has two potential benefit streams. The survivor benefit, based on her deceased husband's earnings record, and her own retirement benefit, based on her own lifetime of Social Security contributions. Most widows assume they must choose one and live with that choice. That is not what the rulebook says. Under POMS RS 00615.090, a widow can claim survivor benefits first, at 60 or at full retirement age, and allow her own retirement benefit to grow untouched in the background. Every year she delays her own benefit past full retirement age, the SSA applies a delayed retirement credit of 8%. For a widow born in 1960 or later, the window runs from 67 to 70, 3 years, 24% in total additional credit. At 70, she switches. She stops receiving the survivor benefit and begins receiving her own retirement benefit, now 24% larger than it would have been at 67. The SSA processes the switch. The higher number takes effect. The widow collects the larger benefit for the rest of her life. For a widow with a meaningful earnings record of her own, a career, a salary, decades of contributions, the lifetime difference between switching at 70 versus claiming her own benefit at 67 can exceed $50,000. Not a projection, not a model. A permanent upward adjustment, authorized under existing law, available only if the widow elects it before age 70. After that birthday, the window closes. The SSA representative who processes the survivor benefit application is not required to mention file and switch. The enrollment form does not reference POMS RS 00615.090. The welcome letter does not explain that a second, larger benefit is accruing in the background. The widow must know the strategy exists. She must ask for it by name. She must act before 70. Same silence. A different kind of loss. The loss of a gain that was always hers to take. Now, the story that makes this real. A retired accountant in Portland, Oregon. Her husband died in 2019, the week after she turned 62. She claimed survivor benefits that year, not at 60, but at 62. A reduction, though not the maximum. She had spent 34 years as a CPA. Her own Social Security earnings record was strong. She did not claim her own retirement benefit. She had read, in a government publication, not in anything the SSA gave her, about delayed retirement credits. She did the calculation herself on paper at her kitchen table, the scratch of pencil against a yellow legal pad. She waited. 8 years. At 70, in 2027, she switches to her own benefit, 24% larger than it would have been at 67. Her lifetime gain, by her own estimate, $62,000. She worked it out herself. With a calculator and a government PDF the SSA never handed her. That is not luck. That is what it looks like when someone does what the system expected her not to do. Most widows do not have 34 years in accounting, and most never find that government PDF. And that is the full weight of what we have covered today. 7 places where the system offered less than it owed and said nothing. Here is the complete map. Mistake 1. Claiming survivor benefits at 60, locking in 71.5% of the deceased spouse's PIA, $516 a month for life. Mistake 2. Missing the 2-year deadline for Form SSA 8 and the $255 lump sum death benefit. Mistake 3. Missing the 8-month Medicare Special Enrollment Period after losing spousal employer coverage, triggering a permanent 10% per year Part B penalty. Mistake 4. Not knowing about QMB and SLMB, programs that eliminate the $185 monthly Part B premium for widows below the income thresholds. Mistake 5. The IRMAA cliff. Prior year joint income triggering a surcharge calculated on income the widow no longer has, with Form SSA 44 as the remedy, the notice never named. Mistake 6. GPO and WEP reductions, disclosed in enrollment documents, processed after the widow has already signed. Mistake 7. Failing to use file and switch under POMS RS 615.090, allowing the own retirement benefit to grow to 70 while drawing survivor benefits, then switching to the larger number. 7 mistakes, all structural, none of them accidents. The system processes what it receives. It does not volunteer what it owes. Every widow who walks into an SSA office or picks up a Medicare enrollment call without knowing these 7 things carries a disadvantage the agency helped build, and carries it for life. Before you go, subscribe and turn on notifications so the next change doesn't catch you off guard. And share this video with someone you know, a parent, a neighbor, a friend on Social Security or Medicare. They probably haven't heard any of this either. I'll see you in the next one.